Good evening and welcome to the weekend edition. My name is Peter Resnicek from ShadowTrader.net. Good to be back with you after a 2-week hiatus. The last video we had here was August 1st. I've been on vacation since then. I am back now, and I did trade all of this week. And this week essentially was characterized by a slow and steady march downward until Friday morning, when the transcript from the Jay Powell speech at Jackson Hole, which is the last one that he'll ever give before he terms out next year, was released. And in that speech, he essentially alluded to the fact that he's probably going to give at least a 25 basis point cut in September. The odds of that, we're going to get into a FedWatch in this program as well, but the odds of that just shot way up and ended the day around 83%, I believe. So it's definitely tilting more in favor of that. And the market got the usual sugar high that it likes, rallying pretty hard, potentially even setting up what I call a seller's shut off pattern. We're going to get into that as well. We're also going to dig a little bit deeper into what was going on this week fundamentally, because we had news from Walmart that essentially was a little bit bearish. First earnings miss that they had in quite a while, and talking specifically about how tariffs will be impacting prices to consumers soon, even though they are trying their darndest to eat those prices now. But you'll see when I share the notes from the CEO how it's just creeping up for them week after week. And I personally think that eventually the consumers are going to shoulder all of this, and they're not going to be, these retailers are not going to be able to stand this, because it's just going to keep cutting into their profits. So this is a major push-pull moment here, I think, in the markets, and especially fundamentally, where we have lower rates coming, but we know labor participation is down and prices are definitely moving up. And I'm not sure how that spells good news for the stock market in the long term, but in the near term, things are looking quite bullish. So we're going to break all that down in the technicals and in the fundamentals today in the weekend edition. As always, the very brief look back before we spend the rest of the show looking forward, hopefully, and we start off with the week in review, talking specifically about the 11 sectors that make up the S&P and a smattering of other important financial instruments and how they fared this week from Monday's open to Friday's close. Remember, that's all that matters. What is the sort of area of price action that is actually tradable, right? Gaps aren't tradable unless you're already there the day before, so I'm not interested in that. So the numbers you're seeing here are Monday morning to Friday's close, and that's why the advance, for instance, in the majors is not that great. When you look at it up here, the S&P barely gained about a third of 1 percentage point on the week, because, as I was alluding to in the opening comments, we were down for the whole beginning of the week, and we only rallied hard on Friday, essentially taking back all of the week's losses in one day. The NASDAQ has been showing relative weakness all week. All of those down days had more downside action in the NDX than in the S&P, and it was clearly reflected at the end of the week, where the NASDAQ was not even able to get positive. When we get into the what's really going on section, talking about the technicals, you're going to see very clearly how the technical outlook in the S&P and the NASDAQ 100, to me, is completely different. But we'll get to that in a second. And the Russell was the big winner as far as the major averages, because obviously it gets juiced the most by the forward look that even there could be lower rates, right? We know that these are the smaller domestic companies that don't have an international footprint and are generally more indebted than other companies. And of course, they need lower rates to help them thrive. So you saw relative strength in the Russell all week, and then especially on Friday with the with Powell's speech, we saw the Russell move up higher. A lot of this was definitely also translated into what happened in the 11 sectors. Namely, notice how technology at the end of the week, being very closely aligned with the NASDAQ 100, technology was down over 1% on the week, which is kind of noteworthy given the amount of the advance that we saw on Friday. Financials were very strong. I'm going to get into that chart. We're going to do a little sector watch in this show, because I think there's definitely a couple of things I want to point out that are important. Basically, the rest, I should say, of the front end here, I call it kind of the front end, because remember, this is all weighted by how much weight it actually has in the S&P 500. So this XLK by itself is like 33%, and then it goes down from there. So we go in that order. And so you know that these bottom sectors here, collectively, they make up like 7 to 10% of the market. They don't move the market as much. So you really want to keep your focus on what I call the front end. And that front end was really dominated by financials, but more importantly, discretionary. And this is actually out of order here. This actually shouldn't be this way because discretionary is actually weighted heavier in the market than healthcare. Discretionary is important. And we saw a big move in consumer discretionary today. And I think that that sector in general, excuse me, is going to have a lot of impact going forward in terms of what I was saying in the intro, where I think that the longer term outlook for the stock market is bearish, but I think the shorter term outlook for the stock market is certainly bullish. The problem is, of course, timing is everything. When does that longer term bearishness start? Well, the charts are going to tell us when that happens. So we're not going to try to, get ahead of that or guess. But this consumer discretionary to me will be a key to it because that's the thing that we haven't seen yet. We still haven't seen the consumer obviously be slowing down. If they were, this sector wouldn't be so strong. And yet we know what's coming, right? We know that higher prices are already here now. Tariff implications are going to bring even higher prices in the near future. And we'll see if this sector cracks at all. Communications was kind of flat. Consumer staples, this was interesting because it was definitely a rotational market this week where you saw some money coming out of staples because that sector was relatively weak on Friday. And you can see how at the end of the week it only tacked on 0.5% gain. All right, bonds fared pretty well because interest rates dropped. Obviously, you can see the yield on the 10-year dropped by almost a full percentage point. VIX was down 10%. Pretty much that all happened on Friday. That's normal. And the specter, if you will, I don't know if that's the right word because that's usually negative, but the specter of lower rates on the horizon obviously is good for gold. And it was also good for Bitcoin, although not enough to get it positive on the week because Bitcoin has been pretty darn weak. It came down into the 111,000, if you will, over the course of the week. And then, like with a lot of assets, the big rally really only happened on Friday. And that's what caused, that's what this change is measured from Monday to Friday. So you see a very small decline in Bitcoin because obviously it made up a lot of ground at the end of the week. So that's the weekend review as far as sectors are concerned. As I talked about on August 1st, and I'm trying to develop this into something bigger when we get to the new show that I'm so excited about. Update on that, equipment is in and we're starting some more build on that studio next week and I'm really excited about that. And I think we might actually have weekend edition 2.0, or is it like 3.0, 4.0, 5.0 by now? I don't know. This show has gone through so many iterations, but we could have the new weekend edition, I think, in early September, which I'm really excited about. And I think you guys are going to really like it. New studio and completely different setup, and it's going to be pretty exciting. But let's just talk. So anyway, so on that note, one of the things that I wanted to add, and you can see here I've changed the slide here, is that one of the things I wanted to add is start talking about stuff like this, which is basically what were the fundamental catalysts that either moved price action during the week, or even if they didn't really move price action, what were the fundamental items that were important to note? Because remember, even if it's not reflected immediately in price action, this stuff is not going away. So first things first, this was the shot heard around the world. This is essentially the one phrase from the Jay Powell speech. Released the transcript at 10 a.m., boom, and this one phrase basically changed everything. I quote, with policy in restrictive territory, meaning rates are high where they are right now, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. And with that, the market just basically took off. So that was the sort of sugar high that we got. And then markets obviously responded in kind. They generally always do when there is the talk of lower rates. We'll see if he follows through or whatever. We'll get to a FedWatch in a second. We'll see what the actual odds of that are. But that being said, here's the other side of the coin. Walmart reported this week, and I thought this was very interesting because this really kind of plays into my thesis that eventually this stuff is going to hurt the market. We shall see. But anyway, Thursday, CEO Doug McMillon stated the impact of tariffs has been gradual enough that any behavioral adjustments by the customer have been somewhat muted. So that's for now. That means that they're not seeing slowdown in traffic or people buying less because of that, because they're basically eating these costs for now. But he warned that the company has seen costs increase each week as it replenishes its inventories at post-tariff price levels. This makes perfect sense, right? Because obviously, who pays tariffs? Importers. Fact. Mic drop. End of story, okay? Importers pay tariffs. Nobody else pays tariffs, only importers. Importers pay tariffs. They are wholesalers who sell to Walmart, etc., or Walmart itself. And right now they are just sort of eating those costs because those tariff increase prices are just coming in little by little, right? Because there were a lot of changes to that, etc. And so the CEO right here is saying that they are replenishing their inventories at post-tariff price levels, and I quote, a trend that he expects to continue into the third and fourth quarters. And while Walmart plans to keep prices as low as possible, some increases are inevitable, especially after the company missed earnings expectations despite its superior revenue growth. And mind you, this was the first time that they missed earnings in a while. It's been a few years since they've had an earnings miss, and this was it. So higher prices are coming. And I don't know how that, when you put that together with that huge jobs revision down that we had on August 1st, I'm not sure how this translates into continued growth, which is really what the market wants to see. So we shall see. So that was one thing that we got this week. That was Walmart on Thursday. And then Home Depot CEO Ted Decker also coming out with some words here, attributed, and I quote, a slight decrease in the company's second quarter transactions to, quote, modest pullback in promotions for outdoor and garden materials as a way to offset tariff costs. So they are doing everything they can behind the scenes with what they call promotions, which could be coupons, whatever, anything they can do to kind of keep customers in the stores, keep them buying, because their prices behind the scenes are rising. And they're, and I quote, using that as a way to offset tariff costs. And then here's the other thing. And Target, another big retailer, decided not to repurchase any shares in the second quarter, citing tariff uncertainty. So bottom line is that I feel is the big push-pull here, in that you have this market that just got this sugar rush, like exactly what it wanted, over potentially lower rates. But these rates are going to be lowered in the face of inflation that is proven to be not only very sticky, but also probably going higher in Q3 and Q4. Does that really make a lot of sense? To me, probably not. And we're going to see how the market responds in the bigger picture later on. But again, for now, feels kind of bullish because I am not one to ever fight price action, and you know that. So let's get into what's really going on. And we're going to take a look at the charts. I'm going to show you exactly what's going on and why this is, for now, bullish in the short term. Okay, what's really going on, or as I like to call it, the most important part of this show, right? Where we can take a look at the S&P and the NASDAQ 100, dailies, weeklies, whatever, jump in time frames, whatever, and figure out what's really popping. And this is important because this is what I call a pattern in this index that I call sellers shut off. There's a lot of terms, and you can check all these out on shadowtrader.net in the glossary section, which is under the resources tab. There's a good number of terms that over the years that I've been doing this, which is quite a while, I have coined my own terms for things, such as candles lining up same size bodies, right? When there's a congestion and the bodies of the candles are all the same size, so it goes like red, green, red, green, red, green. That's just one example. There's many of them. And one of those is also a pattern I call sellers shut off. And what does sellers shut off mean, or what is it? Sellers shut off is when a green candle negates multiple red candles. And that's essentially what we got on Friday, where you can see how there are multiple red candles here inside of the green candle. I'll just make this larger for everybody to see so everybody can see it clearly. Right, you can clearly see how this one red candle encompasses all this downward action inside of it. So that's noteworthy. Why do I call it sellers shut off? It's because the sellers are essentially shut off from where they were here at the lows. And usually the way I like to look at it is that you basically want to be thinking of it as a short put environment anywhere below that low. So you find this pattern and you sell the puts below it, because the theory is that it's very, very difficult for the market to go like this and return back to those lows. So even though those puts may not have the best trade location, right, because you're selling puts when the market is high, I prefer to sell puts when the market is low. I totally understand that. That is negated, if you will, by the fact that you have a lot higher odds of those puts going to zero, because the the pattern just generally doesn't play out that way. It's hard to retrace that. Now, that being said, this is what I alluded to earlier, a sugar high, basically, right? This happened not because of any amazing, fundamental data or amazing, some super important catalyst or whatever. This happened simply because the market is going to be probably getting a rate cut in September. And even that's not 100% sure, but more than likely we're getting it and the market did this. So first thing you want to think about is Monday, Tuesday, maybe even into Wednesday of next week, wait to see if this holds. If this candle gets retraced, all bets are off on the upside. Seriously, like everything is going to change completely. And to me, that's going to be a huge short signal if this gets retraced, because you have all these people in Friday's bar who are wrong. Generally, it doesn't occur that way, but we shall see. The other thing I want everybody to focus on is the fact that we've got an all-time high here that we're very, very close to. In the cash market, it's 6481.34. And if I mouse over Friday's action, you can see that the high up there in the upper left-hand corner was 6478.89. That was today's high. So you're literally talking about 2 points-ish off of that high. So price action above that, more than likely a breakout point. I would be looking at this as a go with, monitoring for continuation and basically watching internals very closely in context to make sure that it confirms. But if it does, I would be going with. This is why, and I have to reiterate this because it's super important, I'm telling you things in this video, pointing to things like the comments from the Home Depot CEO, the Walmart CEO, etc. These things, to me at least, and this is just my opinion, I don't think they're bullish for the market in the bigger picture. I think that the market and the economy as a whole is extremely driven by consumption, and any signs of slowdown in that consumption should be paid attention to, and prices are probably going higher from where they are here rather than lower, and that should cut off consumption to a degree. And I think this is going to be problematic, especially if you put it together with a softer labor market, right? Just makes perfect sense, right? So, however, in the face of that, the short-term outlook to me is bullish. This is a seller shut-off pattern. You were coming down very hesitatingly. It's interesting also, like, you had this action here, which was kind of this big hammer bar. We had this retracement back to the upside on Wednesday. And I was talking about this to everybody in the weekly room and in the Peter's Pre-Market Perspective, how this bar stayed inside. And even though it was weak, it was still held this low. That's kind of important. And then from there, obviously, all the short covering ensued that took the market up. I personally don't think that the market would have been as strong had it not been against the backdrop of this down move, because everybody was short in this market coming into the speech, right? That makes perfect sense. So that's also another thing that I want you to pay attention to next week in terms of if there is follow through or not, because remember that the market essentially conducts old business before it conducts new business. And in this case, I fear that today happened to be a lot of old business. What is old business? Old business is certainly a reversing of transactions that are already in the market. And we know that the majority of those transactions had to be shorts covering. And how do we know this? Simply because the prior 5 days of price action was this. All down, right? So if the prior 5 days of price action is all down and you're still at those depressed levels when the rally starts, the rally is probably made up of a lot of short covering. That's old business. What is new business is when new money comes into the market. I like to call those new money buyers, and those are the people that really fuel a rally. Why is that? Because new business should hold positions, meaning that they support the bid on pullbacks, and when they buy, they're not getting out quickly for a quick gain. They are new business. They are looking to hold those equities or whatever for a longer term because they think the market is more bullish now and they see an upward outlook for stocks. So keep that in mind. So next week is going to be all about whether or not new business steps into this market and continues this rally, or was this Friday just kind of, as I call it, a sugar high or not. All right, let's take a look at the NDX. This is what I alluded to in the opening comments of the show. I was saying that there's a huge divergence between what's going on in the NASDAQ 100 and in the S&P, and it is so clear here because A, you do not have the seller's shut-off pattern. You barely took back like I don't know, 1.5 bars here of the downtrend. You didn't take back all those. And the S&P, as we know, rallied all the way to the all-time high here, and tech has been lagging, and it literally barely even made it up, didn't get anywhere close to that almost 24,000 level, which is the all-time high. Basically, you're still kind of stuck kind of in the middle, and the 8 EMA is threatening to pinch down through the 21 EMA. We'll see if that happens. If this stays weak and it's like this, you might actually get that pinch to the downside. And this in and of itself is really huge, I think, in terms of a technical signal, because you cannot have these two sectors, indices rather, I should say, not sectors. You cannot have these two sectors be this out of whack and have this NDX dragging its feet so much and expect the S&P to keep going. It's just not going to work that way. It's going to be acting as a drag on the S&P. So I want you to watch this as well very closely next week. The NASDAQ needs to get in gear, and a lot of these tech stocks have been seriously lagging. And I'm going to touch upon that a little bit later in the program in the charts to watch section, because I think the charts to watch right now are not only Fangman plus T, but a lot of the speculative, dare I say, hot stocks that everybody has liked lately, right? Which is AI, Reddit, et cetera, et cetera. There's a lot of stocks that are just hot right now that to me have a lot of speculative money in them. And those stocks did essentially not really rally as much as you would have expected on Friday with the rest of the market. And I think that could be somewhat of a tell, right? So plenty to think about, I think, for next week in the charts of the S&P and the NASDAQ 100. Basically, watch that divergence. All right, real quick, little FedWatch here. Obviously, because we got the Powell speech at Jackson Hole today, I just wanted to show this slide. It's one I'm sure you've seen before. We talk about it a lot. These are the Fed funds futures odds of policy adjustments, and the odds now are 83%. Only two main takeaways I want to talk about from this real quick. This went up over 90% during the course of the day and then faded back a little bit as the day progressed and ended the day basically here at 83%, which means that there is still a 17% chance that we don't get a cut. This is basically staying the same, and this is going down 25 basis points. That's the first takeaway, is just the fact this actually came down from its highest level. So it's not a done deal. But the other takeaway to me is look at how much this has changed over time. Like coming down 1/4 point would be here, moving it down to 4 to 4 1/4. Again, 83 now. It was 75% yesterday. A week ago, however, it was 85, and then a month ago it was 58. So obviously it's trending in that direction and holding pretty firm. So we'll see if we actually get this in September, but this is always something to watch very, very closely, I think, see what the odds are of the cut, but for now it seems to be holding steady. And I'd say 83% is probably high enough to know that it's a done deal at this point, unless we see some major shifts in the labor market between now and then. Probably going to be getting that cut in September. Okay, time now for Sector Watch. This is where we focus on one or a couple of the sectors in the S&P 500. And today we're going to talk about two sectors, because I feel like the two that we're going to talk about is really the theme of this video, is it not? It's the sort of push-pull between consumer discretionary and technology, one of which being very strong and one of which being not so strong. So let's talk about these two sectors here. First being, of course, XLY, which is the ETF for consumer discretionary. This is 10.4% of the market, so just keep that in mind. It's pretty high weight. It's like the third highest weight after financials, and of course technology is the first. And today we saw this huge advance in consumer discretionary, which basically took it here above a swing high, but not up to this all-time high here. So basically the thing is that will the consumer discretionary stocks continue this rally and move up to this 240 level, whereupon that's going to be very interesting, because it's going to be coming up here, and the question is, do they continue to just kind of dribble higher, or will it double top and turn around? This, I think, could be some headwind for the market as a whole if we were to get up to that all-time high in discretionary. And remember, this is about 10.5% of the market. So this is the strong part that I felt during the course of today was really pushing the market, and obviously financials as well. We're not going to get into the chart, but financials were up less than discretionary. They were up 1.15 today on the day from the open, and they are 13.8% of the market, so a little bit more. But let's get into this tech here, because this is where we get into the whole divergence thing about the relative weakness. Notice how the 8 is now starting to pinch through the 21 here. Very, very important. That is bearish if it happens, but it could just be a glance, right? Sometimes you'll have the moving averages go like this, and they just sort of glance. It's like a kind of a touch, and it keeps going. So we'll see if it's that, or if there's some weakness in tech next week, and you get some red bars here, then you probably have this 8 EMA pinch down. And that's why this is very, very important to note, because unlike discretionary, which seems so strong and is only 10.5% of the market, this is 34% of the market currently. Just think about that. This is 34% of the market. It's very, very important. And this is why I was saying as well that it's virtually impossible, I think, over a longer time period for that NDX to be completely decoupled from the S&P 500 and not have some of that weakness bleed in. So this is going to be very, very noteworthy going forward. These are the two sectors I think everybody should be watching. Watch consumer discretionary and watch technology. Obviously, you're going to see if that consumer discretionary can march its way up to that 240 level in the ETF. And you also want to see if this XLK starts to participate, because for now, this seems like a lot of relative weakness to me in tech. And again, that is fueling most of the market. Charts to watch next week are going to be AI high flyers and Fangman plus T, basically all of the tech stuff that everybody's in love with, that I feel has been relatively weak recently and showed a lot of relative weakness on Friday, because these stocks did not participate fully, or as much as I feel they should have, in the rally that we saw on Friday. So first exhibit here is Reddit. Stock's been absolutely on fire after this earnings gap. And since then, came down early in the week with the rest of the market. It's kind of a very textbook decline right to the 21, which was a buy point. But again, my focus is on the fact that what happened on Friday, notice that it just rallied with the market and then gave it all back. If you switch this to an intraday chart, you can clearly see it plain as day. It was the classic sugar high, right? And what does a sugar high do? It wears off. And then it just falls apart, right? So this is the 10 a.m. Powell right here, right, with everything else. And then it spent the rest of the day falling apart and going lower. So this is the type of thing that I don't want to see if I was interested in like a long-term hold, or even some of the weekly option stuff that I do, which has a 2 to 5 to 10 day outlook. I would not be interested in stuff like that. Palantir also, to me, is showing some relative weakness. Again, why do I show you these stocks? Because I'm showing you the stocks that are like the excuse me, the darlings of the market. This is important, right? Obviously, leadership can change. I'm not ignorant to that. I get it. Leadership can change and it moves and shifts, but I'm still a big believer that this stuff is very, very important. And I think that at least short-term momentum traders, or even some longer-term investors that are having trouble with these stocks, you never know what they're going to do, how they're going to act psychologically, if they're going to start pulling money out of these stocks and also staying out of the market for a little bit instead of rotating that money into some of the stronger sectors. So we shall see. But notice Palantir's activity on Friday. It could not even make it to the declining 821, and the 821 is pretty much pinched at this point. So that's what we call it when one faster moving average moves through the slower. That 821 exponential looks like it's pinching, and Palantir is struggling here a little bit. So that's just yet another example. Let's look at some Fangman plus T stuff. Apple had a big surge while I was away and broke out of this really key pattern here that was just basically a big consolidation. And when it broke out, it had a nice rally, but it's given a lot of that back. And again, I'm just talking about what was the participation on Friday in relation to the market. Like, Apple is one of the heaviest weights in the whole S&P. And what did the S&P do? We know that the bar in the S&P went like this. Literally went just like that, and it closed, it had a high very close to the all-time high. Did Apple do anything like that? No, not even close. It didn't do anything like that. Let's look at just a couple more, especially the ones that are very AI oriented. Like Microsoft is all about AI, right? And look what happened. Nothing, essentially. I mean, it just It's coming down very close to this key 500 level, which is a big round number. And the rally today was so weak that it barely just squeaked up to the 8 EMA and backed off. And this one has a clear pinch on it, right? The 821 has pinched to the downside. So you really don't want to be looking at Microsoft long unless that reverses and pinches back through the upside. All right, let's look at a couple others here. Netflix, not really involved in the AI trade too much, but the stock was flat to down. It was actually red today. Meta, right up to the declining 8. Again, not as big of a rally as you would expect. And of course, can't not talk about NVIDIA, which was decently strong, but again, nowhere near as strong as the market, and is also sitting on a declining 8. Doesn't look like that one's going to have a pinch lower. ServiceNow, let's wrap it up with that one. And I only remember this one because one of my subscribers in the weekly options room asked me about Now. And I thought, okay, this is a good one to talk about because it is in that space. And to me, the stock's just relatively weak. It basically did the gap fill here, which is kind of doing what it was supposed to the 840 area, kind of a pretty perfect gap fill. And yet, what has the bounce been since then? It needs to get in gear. And again, this is just basically the type of relative weakness that I think that I would avoid. So in a nutshell, watch this speculative stuff, watch this AI stuff, and watch your tech next week and see what it does, because I feel that the market is very, very beholden to what's going on in these stocks. Even if you didn't see it that much, I should say, today in the S&P, I feel that eventually you will. Let's take a quick looking ahead now just to see what's on the slate for economic data and earnings. Not too much going on next week, but nothing Monday, as you can see. Certainly very, very quiet. Consumer confidence number is going to come on Tuesday from the University of Michigan. That's a pretty important one. Usually gets released around 10 a.m. Eastern. Market can certainly move on that. And then we've got some big retailers on Wednesday reporting with Kohl's and Williams-Sonoma. So we'll see if that continues the trend that we saw with Walmart and Home Depot, etc., with the negative comments about the tariffs. Pay very close attention to what happens on the conference calls of those earnings and see if they mention tariffs and higher prices. But also NVIDIA is going to be reporting, and that is, of course, very, very important. Market should move on that. That's a biggie. Thursday's usual initial claims, continuing claims, and then more retailers, which is Best Buy and Dick's. And again, these are going to be very much in focus next week. You want to pay attention to those conference calls, see what they say vis-a-vis higher prices, etc. Friday is going to be PC and Core PC. Those are both very, very important. And Alibaba is also going to report on Friday as well, right? So that is our looking ahead for the week of August 25th and August 29th, taking us into the end of the month. And that's my show for today. Thank you so much for spending a little bit of your weekend with me. Quick reminder, if you could, please hit the like and subscribe button so that we can continue to grow this channel. I'm also very, very excited to be bringing you the new version of this show very, very soon. Be on the lookout for that at the new studio. We're really excited. There's going to be some major changes here to this show, and it's going to be really cool. So I think you're going to enjoy it very much. Let's recap a little bit of what we talked about and basically just encapsulate, if we could, in a nutshell, where I think this market is right now. S&P is quite bullish right now with the sellers shut-off pattern coming very, very close to that all-time high. So you're going to be watching early next week to see if that all-time high can get taken. I think it should be a go-with pattern. What does go with means? That you go with it, that it's an initiating buy pattern. Hopefully new money buyers will come into the market, take the market higher above that level. What is the caveat here, however, is the potential that the NDX acts as a drag with, we saw a lot of those stocks in tech, and especially, remember, pay attention to those high flyers, the AI names, the darlings, the stuff everybody likes. All that stuff underperformed big, and my thought is that if that underperformed that much on a day like today, Friday, August 22nd, which couldn't really be any more bullish in terms of what the futures were doing, and it didn't carry those stocks forward, that may leave us scratching our heads a little bit next week. So you want to be watching that NDX relative weakness and see if it drags on the S&P or what happens. Again, the NDX, if you look at it technically, has a lot of work to do before it gets anywhere near its all-time high. So we shall see. All right, that's my show for today. Again, thank you so much for hanging out. As always, coming at you from beautiful Los Angeles, California, I wish you good trading and good night.